I want you to stop what you're doing right now. I mean it. Put down whatever you're holding, sit down, and listen to me very carefully, because what I am about to tell you is not a theory. It is not a prediction from some talking head on television who has never actually managed real money through a real crisis. This is coming from someone who has sat across the table from the most powerful financial institutions in the world, who has bet against governments and won, and who has watched with his own two eyes the exact same warning signs appearing today that appeared before every single financial catastrophe of the last 50 years. And right now, those warning signs are not just appearing, they are screaming. I have been in this business for over 4 decades. I started managing money when interest rates were through the roof and America was in the grip of stagflation. I have navigated the crash of 1987, the bond market collapse of 1994, the Asian financial crisis, the dot-com bust, the 2008 financial crisis, and every turbulent cycle in between. And in all of that time, through all of those crises, I have never once walked up to my bank and found the door locked. I have never once tried to withdraw my own money and been told no. But I want you to understand something deeply, something that keeps me up at night. We are now closer to that moment than we have ever been in modern American history. And most people, especially people your age who have spent a lifetime building savings, are completely unprepared for it. Let me tell you exactly why I believe this. And let me do it with numbers, because numbers do not lie, even when politicians do. Right now, as of this moment in 2026, the United States of America is carrying over $39 trillion in national debt. Let that number sit with you for a second. $39 trillion. That is not a budget problem. That is not a fiscal challenge. That is a structural crisis that has been building for over 2 decades while Washington looked the other way, printed money, cut taxes without cutting spending, and handed the bill to your generation and every generation that comes after you. And what makes this moment uniquely dangerous is what is happening to the cost of carrying that debt. Right now, the federal government is paying more than $11 billion every single week just in interest on what it owes. Not paying down the principal, not investing in roads or defense or health care, just the interest. $11 billion a week to service a debt that keeps growing because we are spending 40% more than we are taking in every single year. Now here is where it gets personal for you. The Congressional Budget Office has put out projections that net interest payments will total $16.2 trillion over the next decade alone, rising from $1 trillion this year to over $2 trillion annually by 2036. Interest payments are already the 3rd largest spending category in the entire federal budget, behind only Social Security and Medicare. And those 2 programs are not safe either. Social Security's trust fund is on track to be depleted by 2032. When that happens, by law, benefits get cut automatically by around 28%. Not maybe. Not if Congress doesn't act. Automatically. By law. A typical couple age 60 today, who retires when that insolvency hits, is looking at losing roughly $1,400 a year in benefits. That is not a scare tactic. That is math. Now I want to bring this back to the banks, because that is what matters most to your immediate financial safety. In January of 2026, the first American bank failure of the year was confirmed. Metropolitan Capital Bank and Trust in Illinois was shut down by regulators. The FDIC stepped in, called it routine, transferred the deposits, and moved on. And the financial media barely covered it. But here is what the financial media will never tell you, because they are too busy cheerleading for a market that is sitting on a mountain of hidden risk. Metropolitan Capital Bank did not fail because of bad management in isolation. It failed because in a high interest rate environment, banks that made long duration loans and held long duration securities are sitting on unrealized losses that are slowly bleeding them dry. The FDIC knows this. They have been tracking unrealized losses across the entire banking system, and those losses remain enormous, particularly at smaller and regional banks. The stress is there. It has not disappeared. It has simply been papered over. I want you to think back to March 2023. Silicon Valley Bank, Signature Bank, First Republic Bank. Three major institutions gone within weeks of each other, carrying a combined $549 billion in assets. That was the worst year for bank failures by asset value since the year 2000. And what happened at Silicon Valley Bank is exactly the template for what can happen at any bank that has a confidence problem. Once word got out that SVB had unrealized losses on its bond portfolio, depositors started pulling money. The word spread on social media over a weekend. By Monday morning, the bank was finished. The speed of that run was unlike anything ever seen before in banking history, because we now live in a world where you can wire your entire life savings out of a bank in 30 seconds from your phone. When confidence breaks, it does not break slowly anymore. It breaks all at once. Now I am not telling you that a massive bank failure is happening tomorrow. What I am telling you is that the conditions that allow for a bank run, the conditions that allow for withdrawal restrictions, are more present today than they have been at any point since 2008. And I want to be precise about what withdrawal restrictions actually look like, because most people think they will get some kind of official announcement. They will not. There is no press conference. There is no warning letter in the mail. What happens is that a bank quietly suspends large wire transfers, or a bank puts a 3 to 5 day hold on cash withdrawal requests above a certain amount, or a bank closes its branches early under some vague operational excuse while the regulators are scrambling in the background. By the time most people realize what is happening, the window to act has already closed. And here is something that almost nobody talks about: the FDIC insurance limit. The FDIC insures deposits up to $250,000 per account holder, per institution, per ownership category. That limit has not changed since 2010. That was 16 years ago. In a world where inflation has eroded purchasing power dramatically, where retirees are sitting on decades of accumulated savings, that $250,000 ceiling covers less and less of what many Americans actually have in their accounts. And during the SVB crisis, the only reason uninsured depositors were made whole was because regulators invoked a systemic risk exception. There is no guarantee they do that again. There is no legal requirement for them to do it. It was a discretionary decision made under extreme political pressure, and next time, that pressure may not be enough. So what does this all mean for you? Let me tell you what I would do. Let me tell you what I actually think about when I look at the environment we are in right now, and let me be as direct as I know how to be. The first thing you need to do is understand where your money actually is and how much of it is FDIC insured. If you have more than $250,000 at a single institution, you need to address that immediately. The solution is not complicated. You spread your deposits across multiple institutions and multiple account ownership categories. A joint account, an individual account, and a retirement account at the same bank are each insured separately up to $250,000. You need to know this, and you need to act on it if you have not already. This is not paranoia. This is the same basic portfolio hygiene that any serious financial professional will tell you is non-negotiable. The second thing I want you to think about is cash, physical cash. I am not telling you to pull all your money out of the banking system and bury it in your backyard. That would be extreme, and it would be foolish. What I am telling you is that having some meaningful amount of physical cash on hand, enough to cover 3 to 6 months of essential living expenses, is a rational and reasonable precaution in a world where digital systems can and do fail. In 2023, when Signature Bank collapsed, there were depositors who could not access their funds for days. Days. In a world where most Americans have almost nothing in physical cash and rely entirely on debit cards and electronic transfers, even a 72-hour disruption to banking access can become a genuine emergency. I am asking you to make sure you are not in that position. The third thing I want you to think about is what you own outside the banking system entirely. I am talking about hard assets. I have been vocal about this for years. Gold is not an investment in the traditional sense. It is not something I look at for its return potential the way I look at a stock. Gold is financial insurance. It is the one asset that has survived every currency crisis, every sovereign debt restructuring, every banking collapse in recorded human history. I am not saying put everything into gold. I am saying that having somewhere between 5 and 15% of your net worth in physical gold and silver is a completely rational hedge against the kind of monetary disorder that the numbers I just walked you through are pointing toward. When governments debase their currencies to service debt they can no longer afford through honest means, gold tells the truth that everything else is trying to hide. The fourth thing, and this is specifically for anyone who is holding a large portion of their retirement savings in long-duration treasury bonds or bond funds, I want you to hear me very clearly. I have had short positions against U.S. Treasury bonds that at one point represented 15 to 20% of my portfolio. Not because I do not respect the United States of America, because I respect the math. When a government is spending 40% more than it collects and the trajectory of its debt is pointing toward 131% of GDP by 2036, the bond market eventually prices in that risk. The 10-year Treasury yield is expected to keep climbing. When yields rise, bond prices fall. If you bought long-duration bonds or bond funds thinking they were safe because they are government-backed, I want you to understand that the price risk on those instruments in this environment is very real. The 60-40 portfolio, the idea that you balance stocks with bonds for stability, has been quietly destroyed by the reality of an environment where stocks and bonds go down at the same time. MarketWatch called it the silent wealth killer in 2025. They were right. The fifth thing I want to say is about Social Security. And I want to be honest with you about something that most people in my position are reluctant to say. If you are 60 to 65 years old and you are counting on Social Security as a primary pillar of your retirement income, you need to plan right now for the possibility that those benefits are going to be cut. Not eliminated, not stolen, but cut because the math of the trust fund is not fixable without either massive tax increases or benefit reductions or some combination of both. I have spent years warning that the fiscal recklessness of the last 2 decades was going to come back around. When I gave a speech at the University of Southern California and said that the situation was worse than I had imagined, people thought I was being dramatic. I was not being dramatic. I was being accurate. And the latest projections from the CBO and the Committee for a Responsible Federal Budget show that a 28% across the board cut to Social Security retirement benefits at the point of trust fund insolvency in 2032 is the baseline scenario if Congress does nothing. 6 years from now, plan for it. Now let me pull all of this together because I want to make sure you leave this video with a clear picture of exactly what is happening and exactly what you need to do. What is happening is not a single event. It is not one bank failing or one bad economic report. What is happening is a slow, grinding convergence of fiscal irresponsibility, monetary distortion, and structural debt that has been building for over 2 decades and is now reaching a point where the math becomes unavoidable. The federal government is spending roughly $11 billion a week just on interest. A third of all outstanding U.S. Treasury debt is maturing and needs to be refinanced at higher rates. The FDIC is monitoring unrealized losses across the banking system that have not disappeared but have been quietly absorbed. And underneath all of this, the 60-plus generation is sitting on the largest pool of accumulated personal wealth in American history, wealth that is almost entirely concentrated in the financial system through bank deposits, 401k accounts, IRAs, and pension funds, all of which are exposed to exactly the kind of systemic disruption I have been describing. I want to be clear about something else. I am not a doom merchant. I have made a career out of finding opportunity in exactly these kinds of environments. The 1992 sterling trade with George Soros was not about betting that Britain would fail. It was about recognizing a mathematical reality that the Bank of England was trying to deny and positioning ourselves before the market caught up to the truth. That is what I am asking you to do right now. Not to panic, not to empty your accounts and hide under the bed, but to look at the mathematical reality of where we are. Recognize that the current situation is unsustainable by every metric that serious analysts use to measure fiscal health, and make the quiet, deliberate adjustments that protect you before the market finishes catching up to the truth. Because here is the final thing I want to leave you with, and this is the most important thing I will say today. Every financial crisis in my lifetime has had one defining characteristic. The people who came through it in good shape were not the smartest people in the room. They were not the people with the best connections or the highest paid advisors. They were the people who took the threat seriously early, who made boring, unglamorous, unsexy adjustments to how their money was positioned while everyone else was still telling them they were being paranoid. The people who lost the most were not the people who had the least. They were the people who had the most and who waited too long, who assumed that because things had been fine yesterday, they would be fine tomorrow, who trusted that the system would protect them because the system had always protected them before. The system is under more strain right now than it has been in a very long time. I am not saying it is going to collapse. I am saying the risk of a serious disruption to normal banking and financial function in the next several years is high enough that any rational person should be preparing for it. It's the way you prepare for a storm. You do not wait until you can hear the thunder. You check your supplies and batten down the hatches before the weather report starts telling you to worry. Check your FDIC coverage today. Know exactly how much of your savings is actually insured. Spread your deposits if you need to. Keep some physical cash at home, not a fortune, but enough. Look seriously at whether you have any exposure to hard assets, like gold as a hedge against monetary disorder. Rethink your bond exposure in an environment of rising yields and rising debt, and build a retirement income plan that does not assume Social Security will pay you its full benefit in 2032 and beyond. This is not politics. This is not left or right. I have criticized Democratic administrations and Republican administrations with equal vigor over the years because fiscal recklessness does not belong to one party. The debt was $10 trillion in 2008. It is $39 trillion today. Both parties built that together over 18 years of choices, and you, the person sitting here watching this video, are the one who is going to feel the consequence of those choices in your retirement years. if you do not take action now. I have been in this business for a very long time,